So now let's talk about the concept of market pricing anomalies. An anomaly, first of all, refers to potential inefficiencies that can cause securities to be mispriced. Now this term is important. These are potential inefficiencies that cause securities to be mispriced. So let's take a simple example. Say you are a researcher and you are conducting what's called a event study on several stocks, and specifically you are interested in an event called a positive earnings surprise, and in your research you, let's say, determine, as in you do this for, let's say, 100 stocks. So for 100 stocks where there is a positive earnings surprise, you look at whether the return is greater, the return on those 100 stocks is greater than what you would expect given the level of riskiness of the stock. Now if you find out that on average the returns are greater than expected, then this would be an example of an anomaly, because we are essentially then implying that the markets are not very efficient, because you've been able to identify a process for getting returns that exceed what you would expect given the level of riskiness of these stocks. But more realistically, here is what you are likely to find. So if you do this study 100 times for 100 different stocks, let's say that for 4 stocks you find that on average the return is greater than expected. So then if you sort of write a research paper just highlighting those 4 stocks, this would be an example of what's called a data mining bias, where you've done the study several times and then you only highlight the situations where you have achieved a result that you want to talk about. The result that you want to talk about in this example might be that you want to show that markets are not efficient, and so you only highlight the subset of your studies where you can make your case. So if you are doing that, essentially you are falling prey to what's called a data mining bias. And in fact, it has been shown that most documented pricing anomalies are often a result of data mining. So if somebody comes and presents to you evidence of a market anomaly, one of the first things you should look at is whether there is a potential data mining bias. And there are, broadly speaking, 2 ways to look for this bias. One is you look at how many studies overall did the researcher conduct before he came up with this evidence, and the other is you should also look at whether there is any economic justification for the results being presented. Another general point is that it is difficult to profit from anomalies after we account for risk and trading costs. So there might be a case where a pricing anomaly seems justified. So stocks with a given criteria might seem underpriced, but when we factor in trading costs and the potentially higher risk, then it might be seen that in the future it is very difficult to generate a abnormal profit. Here again, this profit here is referring to abnormal profit. On this slide, we talk about some observed pricing anomalies. As you can imagine, finance-related researchers have done thousands of studies related to efficient markets, and at least in this reading in the curriculum, some of the observed anomalies have been described, and the curriculum divides them into 3 categories based on how the anomalies were identified. So tests that involved time series data have produced certain observed anomalies documented here, such as the January effect, days of week effect, and so on. So these anomalies were discovered by using time series oriented tests. This category over here of anomalies was discovered or identified using cross-sectional data, and this category using other techniques such as event studies and so on. Here I'll just make a general remark, and on the next few slides we will then get into the details of some of these anomalies which might be important from an exam perspective. But a high-level statement made by the curriculum is as follows: most researchers conclude that observed anomalies are not violations of market efficiency, but rather are the result of statistical methods used to detect anomalies. So the key point here is, even though anomalies have been observed, but these do not in of themselves imply that markets are not efficient, and in fact it often turns out that it is the statistical process that might be somewhat defective, and it is the statistical process or methodology that is resulting in the anomaly, and not the fact that markets are not efficient. And because of this statement, this ties in with a statement on the earlier slide, where essentially we are saying that just because we detect an anomaly, because based on that anomaly we cannot generate abnormal profits in the future. Now let's look at some price series data which have been identified using time series data. One of the most popular anomalies that has been observed in several markets is the January effect. And essentially the January effect is that stocks that are purchased in early January seem to give investors abnormal returns. Now two explanations have been given for this. One explanation is called tax loss selling. So what happens here is, investors, in order to minimize their taxes, sell losing positions in December and then buy them again in early January. So the idea being, when these losing stocks are sold in December, they might already be relatively undervalued, and obviously when multiple investors are selling them, the price goes down. And then in early Jan, when these are bought, then obviously investors are potentially buying them at a relatively low price. So there is a possibility that these stocks will give a abnormal return. The other situation is referred to as window dressing, and the idea here is that many asset managers or portfolio managers might sell stocks in December that have an unusually high risk. The reason being that on 31st December reports are created which show what stocks are in a portfolio, and if an asset manager does not want to show certain stocks in a portfolio, he will sell those stocks only to buy them again in early January. So these are two possible reasons for the January effect. However, it should be emphasized that even though this January effect has been observed in the past, but it does not seem to be persistent anymore. Hence, it would probably not be a good idea to try and seek abnormal returns by exploiting this so-called January effect. So these are some more anomalies that have been discovered or identified in the past, but they don't seem to persist, such as the turn of month effect, which implies that stock returns are higher in days surrounding month end, or days of week effect, which implies that average Monday returns are negative, or the weekend effect, which implies that we have positive Friday returns followed by negative Monday returns, or holiday effect, which implies that pre-holiday returns are higher. So anyway, so these are certain observations. I don't think they are overly important, and the fact is that these do not, while these have been identified in the past, they are not that relevant anymore, or they don't seem to persist any longer. From an exam perspective, two slightly more important effects are the momentum effect and the overreaction effect. So the momentum effect implies that stocks where there is a lot of buying momentum, so a lot of investors are buying, the price of those stocks seems to be going up. So this momentum effect implies that markets are not even weak form efficient, because when you buy on momentum, effectively you are doing a technical analysis and using security market data to profit. So in certain developing market or emerging markets, this seems to be this seems to be an opportunity to make money. But for this slide, it's important to understand what the momentum effect means. The overreaction effect refers to finding stocks that have not performed well over the last few years, and if this is the case, then the stock price might be lower than what it should be, and hence an investor who buys those stocks at a price that is lower than it should be can profit in the future. Next, let's talk about pricing anomalies in the cross-sectional category. So this refers to tests that have been done on cross-sectional data, and a few important points here. First of all, the size effect. What has been shown through certain studies is that small stocks tend to outperform large stocks, and this would imply that obviously markets are inefficient, because if you can make abnormal returns by buying small stocks, then that would suggest that the market is not efficient. The value effect implies that value stocks tend to outperform, say, growth stocks. And this is, as a quick recap, value stocks refers to companies where the price earnings ratios is relatively low, or the market value to book value ratio is relatively low. Some studies have shown that in general value stocks outperform growth stocks. And related to value is this book to market ratio. So that's just the opposite of what the ratio over here. So stocks with, say, book value to market value ratio that is high would in a sense also be value stocks. So high book value to market value ratio means that market value is relatively low given the book value, and studies have shown that these stocks tend to outperform others where this ratio is relatively low. The PE ratio effect generally implies that stocks with relatively low PE ratios tend to perform well. And the value line enigma is a very US centric term where, and I don't think this is highly probable on the exam, but the general idea is value line is a well respected agency in the US that publishes its ratings on stocks and gives predictions on which stocks will do well, and the stocks that they generally identify as ones that will do well tend to outperform. So on this slide, you just need to understand a few core points, and we don't need to get into details. First of all, what does this category mean? It basically means that there are studies done that are other than time series based or other than cross section based. So you might have event studies, for example, which have implied or which have suggested that some more anomalies exist. One anomaly is the closed-end fund discount, which implies that the price of closed-end funds is less than NAV. So that is this anomaly. Earnings surprise implies that stocks that have positive earnings surprises, this means that stocks where the announced earnings tend to be more than what analysts were expecting, these tend to outperform. So what typically has been observed with IPOs, or at least what the anomaly suggests, is that in the very short run, investors tend to be over optimistic about IPOs, which drives the price up initially, but then over time the prices come down. So very often IPOs tend to underperform the market. Distressed securities effect implies that securities that are not doing well, or where there is financial distress, the security prices are below what they should be, and hence they might outperform the market. Stock splits implies that if you have, say, a 2-for-1 split, then that generally sends out a positive signal. So some studies imply that when there are stock splits, then there are potentially abnormal profits to be made. Now finally, let's talk about behavioral finance. So this is a field that talks about how the behavior of investors impacts the financial markets, and within behavior we have to worry about various psychological elements. And from an exam perspective, at least at level 1, as long as you understand the core terms, that's good enough, and this material will be seen in a lot more detail later. So let's just understand some behavioral characteristics that have been observed. So number 1 is loss aversion. So loss aversion implies that investors dislike loss more than they like gains. So what exactly does this mean? You've already studied about this concept of risk aversion. So risk aversion implies that investors dislike volatility. So an investor would prefer a stock that gives returns like this versus a stock that gives returns like that. But what loss aversion implies is that investors are okay as long as our volatility is high on the positive side, but investors dislike the negative volatility. So investors are more risk averse in this negative zone than they are in the positive zone. Next, let's talk about overconfidence. So this implies that investors are often overconfident about the decisions that they make. So sometimes investors overestimate their ability to value securities, and if there are a lot of investors who are overconfident about their abilities, then that might imply that securities might be mispriced. So let's in terms of other behavioral biases, we have representativeness, which means that investors assume that good companies or good industries are also good investments. This might not be the case, because a good company the stock might be overpriced already, and hence a good company is not necessarily a good stock to buy. But this biased representativeness implies that investors think that good companies are also good stocks. Gambler's fallacy means that recent results impact investors' estimates of future probabilities. So if they have seen that a company has done well this quarter, then they assume that the probability of the company doing well in the future is going to be high. So their assumptions or probabilities are heavily impacted by what they have just seen. Mental accounting refers to a situation where investors classify different investments into different mental accounts instead of viewing one holistic portfolio. Conservatism is where investors react unnecessarily slowly to changes. So there might be some bad news about a given stock, but if an investor has held a given stock for the last 5 years, then he might just keep holding on to that stock. Disposition effect is where investors are willing to realize gains but unwilling to realize losses. So the point being, investors, and this is again related to loss aversion to some extent, where investors just do not like to admit that they are making a loss. So if they bought a stock at a certain price and it goes down, rather than selling over here and realizing the loss, they just keep holding on with the hope that the stock will go back up. And finally, narrow framing means that rather than viewing events holistically, investors view events with a very narrow perspective. Information cascades versus herding. So the general idea with information cascades is that sometimes you have uninformed traders and they do not have very clear information. So what they do is they observe other traders who seem to be more informed, and seem to be making decisions based on say more knowledge, and then the uninformed traders simply follow what the more informed traders are doing. So in a sense here, information is then cascading from the more informed traders to the less informed traders, and this isn't necessarily a violation of efficient markets, because if the information with the more informed traders is indeed correct, and the less informed traders are then simply also trading based on that information, then that will mean that any mispricing is corrected much faster, and that actually is good from a efficient market perspective. Many people confuse this term herding with information cascades. There is a subtle difference. With information cascades, we are assuming that the information that is flowing from the more informed to the less informed is actually correct information. Herding simply refers to a psychological trait where investors view other investors taking certain actions, and then a herd mentality kicks in where then everybody starts doing the same thing. So for example, if a few big traders are observed buying XYZ stock, and then everybody herds on and tries to buy that same stock, that is referred to as herding. And that is it. This was a fairly theoretical reading, but as always, I encourage you to do the questions from the curriculum. There are 26 problems in the curriculum, and they are all excellent problems. You will only really understand this material once you do those problems. Also do the problems from the study notes that you use. Please post any comments on post your comments on YouTube if you have any, and if you like this video, then please press on the like button. That is it. Thank you.